Welcome to the deep dive. Today, we're going to get really granular on, well, what is basically the engine of wealth for any long-term plan? We're talking about equities. And we want to go past the simple definitions, stocks, shares, and really look at the mechanics, the risks, and how you fit them into a portfolio that can actually weather a storm. Our listener wants that complete picture, the shortcut to being genuinely informed on this.
That's exactly the mission. The sources we've pulled, they focus on those fundamentals. The risk, the strategy behind owning a piece of a company. We want to really uncover how equities create growth, what's behind that famous volatility, and how you manage it all. We're aiming for insights that go beyond, the common knowledge.
Okay, let's unpack that. And I think we should start right at the core. Most people get that buying a share means you're a part owner, but what's less appreciated is what that ownership really means compared to just, say, lending money to a company by buying a bond.
Right. It's a fascinating distinction. The equity investor, you're basically last in line. If things go wrong, you get paid last. But, and this is the big but, if things go spectacularly right, you're the only one who gets the full upside. Your rights, they include voting, sure, but the real financial benefit comes down to two main paths.
Growth and income. Let's start with income, with dividends. I think that gives a really interesting window into how a company thinks.
Dividends are, they're simply a slice of the profits. But the strategy is so different from company to company. You've got your mature, stable, blue-chip companies.
The big household names.
Exactly. Your big utilities, telecom giants.
Yeah.
They don't have a ton of explosive growth opportunities left. So their strategy is to give out high, stable dividend payments. They're perfect for an investor who wants that predictable income stream.
Which means the opposite has to be true for, let's say, a pure growth company.
Precisely. You look at a hot tech firm or a biotech company, they might be making billions in revenue, but they pay zero dividends.
Why is that?
Because every single dollar of profit they make, they believe the best thing to do is plow it right back into the business. R&D, market expansion, you name it. So for you, the investor, the return is entirely focused on one thing: the hope that the share price goes up over time. That's the growth part.
And this choice, growth versus income, it brings up a really important tactical point for anyone listening: tax. Depending on where you live, how dividends are taxed versus how capital gains are taxed can completely change what you actually take home.
That's such a critical point. It's subtle, but it's huge. With growth stocks, because the return is deferred until you sell, you get to control when you pay the tax.
Yeah.
That gives you so much more flexibility, and it lets your money compound for longer before the tax man gets his share. It just shows why you have to align your goal with the right kind of equity.
Okay, so moving on from the mechanics, we have to talk about the one thing that probably scares most people away from stocks: the volatility. Prices jumping up and down like crazy. That movement is just the market reacting in real time, isn't it?
It is. The market is just this giant machine processing a constant, overwhelming flow of information. You've got earnings reports, economic data, what central banks are doing, and of course, just the raw emotion of investors. Fear and greed. So volatility isn't just price movement. It's the sheer range of possible outcomes.
And people see that range, that volatility, as the enemy. But if you look at financial history, it's really just the price you have to pay for higher returns. Over decades, equities always beat cash and bonds.
That is the crucial reframing. Volatility isn't the problem. Impatience is. The extra return you get from equities, what we call the equity premium, it only shows up if you can stick it out. You need that emotional discipline to ride out the downturns. The second you panic and sell at the bottom, you've just turned a temporary dip into a permanent loss of your own making.
So if we accept that volatility is just part of the deal, the main tool we have to manage it is diversification. And that's way more than just owning some stocks and some bonds. You have to diversify within your stocks.
Precisely. You have to look at it through a few lenses: size, sector, and geography. So on size, you need a mix of big and small. Your large cap blue chip companies, they tend to be more stable. They're global players, so they have lower volatility generally.
Whereas the smaller companies, the mid caps and small caps, that's where you find the potential to really beat the market, right? To find that hidden gem.
You do, but it comes with way more risk. They're much more sensitive to the economy, and they often have lower liquidity. If you own a huge chunk of a small company and you need to sell it fast, you can literally crash the price just by trying to get out. That's a risk you just don't have with a blue chip.
And then there's sector diversification. This is about making sure your portfolio isn't a one-trick pony, that it doesn't just work in one type of economy.
Right. You need some sectors that boom when the economy is expanding, like consumer discretionary stocks. But you have to balance that with defensives for the downturns.
Defenses being things like?
Utilities, infrastructure, healthcare, the services people can't cut back on, no matter how tight money gets. They won't fly as high in a boom, but they won't fall as far in a bust. They smooth out the ride.
Okay, so we've diversified by size and sector, but today risk is global, so we have to talk about geography. But doesn't investing globally just add new risks, like currency swings?
That's a great question. And yes, it absolutely introduces currency risk, geopolitical risk. But the key is that those risks are usually not correlated with what's happening in your home market. The reason emerging markets, for example, are so much more volatile isn't just politics. A huge part of it is the currency. If the local currency there suddenly devalues against, say, the dollar, all those fantastic profits they made suddenly look terrible when you translate them back.
So global diversification gives you a ticket to faster-growing parts of the world, but it also acts as a kind of shock absorber if your own country's market hits a rough patch. So it's a net positive.
Absolutely. As long as you understand the specific risks you're taking on, that diversification is your anchor.
Let's pivot now to something you won't see in a quarterly report, the non-financial stuff. This is where a real deep dive happens. Where do we even start?
We have to start with corporate governance. It's the G in ESG, environmental, social, and governance. It's all about the rules, the accountability, the shareholder rights, and bad governance. It's like a slow-acting poison for a stock.
Why is it so important? I mean, a company could be making tons of money, but if the management is shady or opaque, how does that actually hurt an investor?
It creates a deep systemic instability. Think about a company where the board just rubber stamps whatever the CEO wants, or the financial reporting is impossible to understand. When that lack of transparency or that self-dealing finally comes to light, and it always does, the stock doesn't just dip, it crashes. Because the trust, the foundation, is just gone.
And since you brought up ESG, we should probably clarify what those other factors are. How does the E and the S actually hit a stock price?
They're mainstream risks now. The E for environmental. That's carbon emissions, waste, climate risk. A company that gets hit with massive fines for polluting, its value drops instantly. The S for social, that's labor practices, community relations, a big labor dispute or, a scandal in the supply chain that can lead to boycotts and real damage to the brand and the bottom line.
So these aren't just feel-good issues, they are real operational risks.
Exactly. They are regulatory risks, reputational risks, and ultimately financial risks. A portfolio that screens for these things isn't just ethical, it's often just smarter and more resilient. It's avoiding companies with ticking time bombs inside them.
But maybe even more damaging than a company's own failures is our failure as investors, the behavioral trap. That has to be the single biggest reason people lose money in stocks.
It is incredibly powerful because it's wired into our DNA. Fear and greed are primal emotions. We see investors fall for the herd mentality all the time, chasing whatever is hot in the news, thinking this time it's different.
You see it play out perfectly in every market cycle. People are euphoric at the peak, so they buy high. Then panic sets in at the bottom, and they sell low.
That's the classic mistake. The gut reaction in a downturn is to stop the bleeding, right? So people sell. But all they've done is lock in their losses. They've made them permanent. Honestly, a huge part of an advisor's job isn't picking stocks. It's being that emotional circuit breaker. It's reminding the client of the plan and keeping them from making those timing mistakes.
It sounds like the best advantage an investor can have isn't better information, it's just better patience.
Without a doubt. If you can manage your own fear, you're already halfway to winning.
All right, let's bring this all together into strategy. We know equities are volatile, but we need them for growth. So how do they fit into a plan? And I guess the starting point has to be time horizon.
That's the number one filter. Equities are for long-term goals, 10, 15, 20 years out or more. The reason is that over those long periods, the short-term noise just cancels itself out. The underlying trend of global economic growth takes over. Using equities for a short-term goal, like money you need in 2 years, is just, it's a gamble. It's not investing.
So once you've got that long time frame, you have to decide how to invest. And that really brings up the whole active versus passive debate.
Right. So active management is the hunt for alpha. That's the term for beating the market. Active managers try to find undervalued stocks because they believe the market isn't perfectly efficient. It can work, especially in niche markets, but it costs more.
And passive investing, which is just tracking an index like the S&P 500, you're basically saying, I'll take the market's return. You give up the chance to be a hero for lower costs and predictability.
And that lower cost is so important. The data over decades is just overwhelming. Very few active managers can consistently beat the market after you subtract their higher fees. That difference, maybe it's 1% a year, doesn't sound like much, but compound over 30 years, it's a huge chunk of your potential wealth.
Speaking of costs, we have to hammer this home. The cumulative effect, it's always hidden in the fine print.
It's the silent killer of returns. Trading fees, platform costs, fund charges. An advisor has to justify every single basis point of fees because clients just don't see how 1.5% in total fees can wipe out, a quarter or even a third of their final nest egg. It just eats away at the power of compounding.
Okay, so after all this complexity, what's the final verdict? Should a young investor with 30 years to go just be 100% in stocks?
Well, in theory, that maximizes your potential growth. But in reality, it exposes you to terrifying downturns. And very few people, psychologically, can handle seeing their life savings cut in half, even if they know it's temporary. Equities work best as part of a blend. When you combine them with less correlated assets, like bonds and cash, you get a much smoother, more stable journey. And it means you're never a forced seller in a crisis.
So to wrap up this deep dive, equities are, well, they're essential. They are how you participate in global progress and grow your wealth over the long term. But they're not simple. They demand a plan, diversification, a close eye on costs, and maybe most of all, the discipline to fight your own worst instincts.
That's it. The complexity isn't really in the buying or selling. It's in managing everything around them. The governance, the fees, and your own behavior. Get those things right, and volatile shares become the bedrock of a really confident financial future.
Which leaves a question for you, the listener, to think about. When you consider all the non-financial things that affect a stock's performance, governance, ESG, investor discipline, which one do you think has the biggest hidden impact over the long run? And why do you think it's so often ignored by the day-to-day noise of the market? That's a thought worth exploring as you look at your own strategy.